Shift focus and let's talk about JSW Steel. The record EBITDA performance continues and a large investment as well is something that they've outlined. So let me welcome on board Seshagiri Rao, the joint MD and Group CFO at JSW Steel on the show right now. Mr. Rao, great to have you on the show. Another quarter where the multi-year high steel prices and spreads have elevated quarterly numbers to record levels. But since the month of June, Mr. Rao, domestic steel prices have been falling. What is it that your observation has been, and what your July pricing policy is like?
Yeah, there are some corrections which have happened in the month of June, mostly associated with seasonally subdued quarter. But notwithstanding whatever we are seeing right now in the market, but overall, the supply has substantially increased globally. If I see the first 6 months of the calendar year, the total production, incremental production that has come over last year is almost 126 million tons of more production. But what is important to note is that in spite of very good supplies of 126 million tons, which is a growth of 14% over last year, the prices in the first half in the US went up by 40%, and even in Europe it went up in the similar range. So prices are going up. That means that clearly is indicating that the demand is reasonably strong. So whatever corrections we are seeing right now is mostly seasonal in my view. The cost push is also very, very strong, which we have seen in the last quarter. Iron ore prices went up in India by 52%, whereas quarter on quarter globally it went up over 30%. And the coking coal prices went up by 75%. So there is a very, very strong cost push. So notwithstanding the increase in supply because of the very strong demand that is across the world and the cost push together, I don't expect a very big correction in the steel prices. Some correction cannot be ruled out because of the subdued quarter.
Sure. Mr. Rao, while your June quarter auto steel sales have been strong, we understand that demand has been weakening, especially in the key auto segments, construction as well as appliances market. Help us understand what exactly is the situation on ground?
No, as I mentioned to you that the demand seasonally is weak generally in July and September quarter. But from June onwards, relative to April and May, we are seeing definitely a signs of improvement, which is also got reflected by way of higher demand pickup in the power consumption and appliances, and also the tractors and motor vehicles and the residential construction side. We are seeing definitely some improvement over April and May, what we have seen. But it is a matter of time because of the monsoon, the construction activity will be very, very subdued during this quarter. So because of that, we could see some slowdown in the overall demand. But once the monsoon gets settled, I think once festive season comes, demand will pick up. But globally, I am seeing a very good demand that is coming up. That's why we are not seeing a big correction in the steel prices both in US and Europe. Even though some correction in the Asian markets.
Morning, Mr. Rao. So what is happening on the export front, given that there is a seasonality which has kicked in, both in terms of realizations and also in terms of demand?
It may not be possible for all the producers to go for exports. We have been there in the export market for several years. We are able to increase the supplies in the export markets if there is any weakness or some subdued demand in the domestic market. If you see in the last quarter, our exports were 35% of the total sales. So I think we will operate our plants at full capacity, and then if there is a weakness in the domestic demand, particularly the downstream and value-added products, there is a very good demand in the international markets. We will be able to export them. Number two, the export realizations as on date is better than the domestic prices. But the last 1 year trend, if you see, the domestic prices are always at a discount to the landed cost of imports. or they're tracking little lower than what the global prices are.
And how exactly is the uptick in coal prices impacting you? Because that is one commodity where while steel prices have gone up, cooking coal prices have also gone up by 75%.
No, there is always a gap what they announce and what actually is happening on the ground. If I see the first 6 months of this calendar year, China has produced 504 million tons, which is 59 million tons more than the corresponding year of last year. Their policy says that in this year they want to limit the production to that of last year. Whereas it is already 60 million tons more they have produced over last year. Similarly, look at exports. We are saying export incentive they have withdrawn or rebate. But the exports in the first 6 months of the year from China was 37 million tons against 28 million tons of last year. So their exports were higher, their production was higher than last year. So therefore, there is always a gap what they're driving and what is happening on the ground. I think we have to watch how it will shape up. Only one indication was in the month of June, the production was down to 93.5 million ton compared to 99 million tons in the month of May. So month on month it has come down. But if I look at first 6 months of the year compared with the previous year, there is a substantial increase in supplies. Because supplies are more demand for iron ore, more production, more demand for iron ore. That's why iron ore prices are not coming down. And coking coal prices are not coming down. They are still at elevated levels.
Hi, Mr. Rao. Good morning. I want to talk to you now about the cost bit because I think that's also stealing a lot of attention, really. What sort of pressure have you seen in commodity costs? I know you mentioned coking coal, which has risen, 75% in this last 1 odd year. So is this something that's putting pressure on spreads?
Definitely, coking coal prices are going up. So therefore, there is a pressure on the overall cost of production. If I see even in the last quarter, our costs have gone up by 10%. Out of that, majorly contributed by both coking coal and also iron ore prices. So whatever increases that have happened in the last 3 months and also what is right now, this gets reflected partly in this quarter and partly next quarter. So there will be cost pressure because of the increase in coking coal prices. So that definitely will have an impact on the margins.
All right. And now let's talk about iron ore. The advantage over there is that you've managed to, accumulate a couple of captive iron ore mines for yourself. Now, in these times of cost inflation, I'm sure you're going to be ramping up on mining over there. So I want to understand what sort of cost savings will it bring about for you? And do you think that as you ramp it up, it'll help you maintain margins at maybe, at least 25%, if not these elevated 30-odd% that we've been seeing for the last 2 quarters?
Margins we don't guide. Basically, we guide on volumes. Volume is concerned, whatever we have guided in the beginning of the year, that is 18.5 million ton production, including the production that will come from expansion at Dolvi. And also sales side, we will be able to achieve our guidance. That is how we can talk about it. As far as margins are concerned, there will be a pressure on account of the increase in coking coal prices and also iron ore prices. Iron ore last quarter was 42% of our total consumption was from the captive sources. We wanted to increase to 50% plus. That is what we are working on. We are also investing in the beneficiation plants to improve the quality and digitization and mining equipment. There are a lot of other things which are going on. But the benefit of that will come little later. It may not come in this year. But our captive percentage of the total consumption, that continues to be going up.
Sure. Mr. Rao, all steel companies are currently in capex mode. What can give you an edge as opposed to other companies?
Expansions, whatever we have announced so far, if you see, I think they're in the range of 30,000 rupees to 40,000 rupees per ton of installed capacity. That is the cost we are incurring. Compared to the market with any other company, either in India or globally, I think we are very, very competitive in terms of setting up brownfield projects. So I think in the next 1 or 2 months, that is in this quarter, we are commissioning our Dolvi 5 million ton expansion. That itself will be a big enabler for the company to improve the volumes and also to improve absolute EBITDA, because volume growth will happen in the company.
When the steel cycle is doing so well, Mr. Rao, does it make sense to diversify into a space like paints? Why are you investing in that sector?
What we realized is industrial paints is very much essential for JSW Steel to serve our customers, because we need 1600 shades of colors, which we do on the steel which we produce, basically to give to our customers. What our customers are looking at in assurances and warranties for a longer period of time, 10 years to 15 years warranty on the paint which we give on the steel. So if we have to give it, we need a lot of R&D to be done along with the paint producer, and also do different grades of paints and improve them and bring them in an innovative manner. That is one. Number two is, if I look at the existing paint players in India, very few of them are looking at expanding industrial paint capacities. Whereas JSW Steel is more than doubled or more than tripled, in fact, the capacity of the color-coded lines. Earlier, we used to have 7 lakh tons capacity. Today, we will be close to 2.5 to 3 million tons once all the projects get completed. So this is a huge amount of increase in our paint requirements. When the other players are not increasing capacity of the paints to supply to us, and when we are increasing our capacity, it is very much essential a player is committed to us who will increase their capacity to meet the requirement of JSW Steel. So to secure our supplies in future and also to meet our customer requirement of ensuring and assuring them very high quality and warranties to them, I think it is essential and strategic for us to make this investment. That's why we have taken this call to do the investment and work with them for more and more improvement in the quality of the eventual product we supply to our customer.
Mr. Rao, just to understand, the US operations have turned EBITDA positive. That's because there has been a blockbuster rally in steel stocks. Will it sustain? Because what we are perhaps trying to understand from you, Mr. Rao, is that has the US operations or have the US operations turned profitable and that is a one-off?
No, we have started the operation after refurbishing and revamping both at Ohio and also Baytown in the February and March 2021. So they picked up the capacity, ramped up the capacity during the quarter. So both together have given an EBITDA of $44 million in the last quarter. So in rupee terms, all our overseas operations have contributed positively to 282 crores to EBITDA, as against a loss of over 300 crores in the previous quarter. So that way there is a big turnaround as far as US operations are concerned. We expect that this will not only continue but improve further from here on.
You know, Mr. Rao, from what we've seen in terms of the kind of acquisitions you've been making, IBC cases and otherwise, and also what we've read and produced from your annual reports in terms of the CapEx, we noticed that the acquisitions are very consciously moving towards more downstream and value-added products. So a few years down the line, how will JSW's product mix change? And is this an attempt to sort of delineate yourself from, the steel cycle vagaries?
I think this is an interesting question. If you see, even in the last quarter, even though our overall volume of sales were lower, our value-added products mix has gone up to 61%. So more and more we create our downstream capacity, I think the value-added products continue to be higher. So that gives an incremental EBITDA over the base product. So that adds to the EBITDA and also to the bottom line. The downstream capacities, as I have been telling you, 5 million ton in the earlier, before expansion, it will go up to close to 12 million ton. So that is the kind of downstream capacities we have made investments in the last 2.5 to 3 years time. Most of them will get completed in this financial year. So with that, there will be a huge amount of increase in the basket of total product mix, increasing the proportion of value-added products. They are not only sellable in India, they are exportable. They are very good, high quality downstream products. So that is where I think JSW Steel has an edge over the competition.
Right. Mr. Rao, lastly, you've added another source of power, as we understand, wind and solar through an SPV with JSW Energy. How and when is it going to start and ramp up? And what kind of cost savings do you anticipate because of this move?
Definitely. For instance, today, as a part of our ESG strategy, we said we will reduce our carbon emissions and increase our renewable power. So those are the guidance we have already given. In line with that, we are now signing these PPAs for buying 948 installed capacity of both wind and solar power. This will give us two distinct advantages. One is when we consume fossil fuel power, as per the regulation today, in some of the states, 21% of the power that is consumed from fossil fuels has to be necessarily through renewable sources. In Maharashtra, it is close to 10.6%, so it state to state varies. So there is a RPO obligation on JSW Steel to buy the power from renewable sources. If it is not possible, then we have to buy the certificates, the REC certificates in the market. So there again we have to pay. That means when we consume the power from fossil fuel, we have to pay higher price for the power, plus I have to buy the REC certificates in the market. Instead of that, by entering into this buying of renewable power, then the cost of renewable power is lower than the fossil fuel power, one. Number two is I did not buy the REC certificates. In both the ways, I save the cost. So there is a significant advantage in terms of procuring on a long-term basis the renewable power.
Mr. Rao, great to have you on ET Now today. Thank you so much for taking the time out and joining.